apply right away. My focus is going to be on trading options, which I know some of you may do already, and others of you, options may be something new, something that you're thinking about. And also I'm going to focus on weekly options. And weeklies can be scary sometimes to folks, and so we're going to try to ease your fears here a little bit about that. For those of you who do not know me, I've been trading full-time for 11 years. I administer several advisories, and I've written a number of books. A couple start with basics for those who just don't have any background in option trading at all, and then a number of strategy books. And what we're going to focus on this afternoon is wealth building with weekly options, and it's a short-term strategy that most of the trades last from 1 to 3 days, kind of an average of 2. There's an occasion sometimes when you hold it maybe up to a 4th day, and a few just last 1 day, but an average would be 2 days. I feel like I need to explain a little bit more about myself, that I came to trading kind of late in life, that my family experienced, our business went through a disaster, a flood back in 2004, and it wiped out our gift store, and we had a really hard time coming back from that. Both my husband and I worked in it, and it was like we had all of our eggs in one basket. Not only was the building kind of wiped out and had to go through the whole drying out transition and mold and all of that, but also our inventory, our books, our equipment, computers, all of that. Everything was gone, and financially we had everything tied up in the shop. And so a friend of mine introduced me to options, and I got started. I took a couple classes, and it was just an awesome fit for me. I knew from day one that this was something that I could do, and I did excel at it. I did run into problems along the way. I initially realized that I learned just enough to get myself into trouble, and each time I ran across a subject that didn't work right, I studied like crazy, and I worked at it until I finally was winning more trades than I was losing, and it just kind of went on from there. I consider myself to be the average trader. I'm a mom, as you know. I'm a grandma. I have 7 grandkids. I actually am a great-grandmother at this point. I have 1 great-grandchild, and I'm very proud of that. But I really ended up redefining myself when I was about 55, and this was a whole brand new career for me, and has worked out really, really well. That where we were financially in a bind and didn't know how we were going to pull things back together, I was able to start funding our retirement account and purchased a second home, a property that went with our first home. It just has been the key for financial independence, and I'm so pleased that not only did it work out, but then I've been in a position to help others and to share what I've learned. And it doesn't come from a financial background. It's not like I had the financial education and training. Actually, I'm an artist, and there's a lot of what I have learned. I think I bring this whole different perspective to it, and it sets me apart, and I would like to share some of that with you tonight. That wealth building with weekly options, it's a product in a sense, meaning that it comes with a book that goes over both long and short trades. There is a weekly newsletter that lists candidates and goes over additional educational material and commentary about the market. There is an advisory which can be auto-traded, and the website for it is Weekly Wealth Advisory. Now, as I mentioned, my personal goal was to achieve financial independence, but then I was put in a position where I was able to write the books and bring this information and share it with other folks. So the book has helped me to achieve that, and it reveals all the steps that I used to double my money in 2 days or less a great many times. There are always a few losers, but when you win the majority of the time and you have stops in place, the winners then outpace the losers, and that is what brings you to a point of being able to count on options as being a source to be able to achieve financial independence. I hear from traders every day who are just using these techniques and having great success. On average, I usually invest between $500 and $600 per trade. Now that is not a huge amount. That is what I would consider a reasonable investment for someone who has just a modest trading account. So let's discuss why weekly options. And again, I know that this is kind of scary because we have been taught always in buying options that you want to buy extra time. So weeklies are relatively new when it comes to the stock market. They're celebrating their about the 5th birthday, but they're still new enough that most traders don't understand the advantages, and that's where I'd like to focus for a few minutes here. As traders, we've been taught not only to the value of time, but also to make sure that we buy extra time so our trades have plenty of time to unfold and play out. And this is not the thinking with options at all. Actually, it's the opposite. With weeklies, the aspect of time works in the reverse. We're not looking for extra time to allow our trade to play out, but providing we have the trade direction right, we're seeking protection against the market's fickle change in direction. We're using the short expiration time to our advantage. So there is just a huge number of advantages to weeklies, and let's run through these real quick. They are cost effective. They are a fraction of the cost of monthly options. They have a great deal of flexibility. They're a useful trade vehicle for numerous strategies, straight calls and puts, spreads, covered trades, and so on. Long-term trades are subject to the market changes. With short-term trades, you trade exactly what the market hands out on that particular day. And since weeklies are new every week, a trader can pick and choose to enter the trade at the moment that the action is getting ready to happen. There's no need to tie up your capital waiting for an equity that is going through a pullback or a consolidation period. You are jumping in when the move is getting ready to happen, and then you jump out again. And you can either switch to a new equity, or sometimes you can ride that equity back down again or back up in reverse. That with weeklies, you enjoy 52 expiration periods a year. Weeklies are available on indexes, stocks, and ETFs. The exchanges offer new weeklies on companies that are expected to attract attention each week, so that there's always something new that you can focus your attention on, or you have the consistent, reliable equities that a person could trade week after week after week. And because of the growing popularity of weeklies, there's always a high volume, and it's growing more and more all the time. 1 week a month, all optionable equities become weeklies. Of course, that's the 3rd week of the month. Weeklies are a short-term chartist dream because all you have to do is ask yourself, where will this equity be in a week or less? The shorter time frame allows for more accuracy. Weeklies can be used in conjunction with news releases, with announcements, with earnings, the FOMC minutes, upgrades, downgrades, that they are very, very flexible. But when you have an equity that has some news and it's going to have a burst movement, you can jump in with a weekly, get in on that, and then exit very quickly. Weeklies remain more reasonably priced during periods of higher volatility than the monthly options do. And once the news is released, weeklies suffer less of the volatility crush than monthly options. Okay, advance here, please. There we go. Just a few more of the advantages. The Greeks, weeklies inherently have a greater delta. Weeklies don't suffer from high theta. There's less time value, and so it isn't an issue. Cheaper prices mean you can purchase more contracts for the same total investment. An additional Greek benefit is that gamma is explosive with so little time value. Quick price moves before the market can change directions compounds the benefits and the leverage of option trading. And we're going to look at some very specific examples of this. The exchanges have not too long ago received permission to offer weeklies 5 weeks out in time, but knowing that, you don't want to buy too far out because that kind of reduces the benefits that you might just as well have purchased a monthly option. So here we have two principles that we've kind of covered rather quickly. One is that you have leverage with option trading in and of itself. And now we've discussed quickly the benefits of weekly option leverage. So let's look at some specifics here and see how this actually works. That I have discovered that a 2.5% to say 4% equity price move will often equate to a double in a weekly option premium. So we are looking for stocks that are going to have bigger moves, and the Weekly Wealth Book covers the details of how to be able to do that. Excuse me, just we'll look at a specific trade here for XNLX. That, let's say we had purchased calls after open on November 16th and we paid 79 cents a share, or that would be $79 for a 100-share contract for the November 4th week. That expires the 4th Friday in November, and we purchased the 47.50 strike call. And let's say that we bought 8 contracts for a total investment of $632. That's in that $500 to $600 range that I had mentioned earlier. And we sell at the end of the day on November 20th. The call contracts were worth $1.45 on that day, or $1,160 total, and that's a gain of $528 per contract. And this is an 84% gain in just those few days from the 16th to the 20th. So that's 4 trading days. Now, XLNX's price when we entered the trade was approximately $47, and when we sold, it was $48.80. So that's a $1.80 change in price, and that's a 3.8% increase in the stock's price over those trading days. And yet the option increased 84%. So it's like being able to purchase and control the stock with just what would be a down payment that had you invested the same amount that you would have purchased by buying 100 shares of the stock. that would have been $4,700. You would have compounded what you invested many times over. So this gives you a great example of not just the leverage of option trading, but a great example of weekly option leverage. So this is their chart, and this is where I want to kind of get down into the nitty-gritty of the weekly wealth strategy. That this is your normal, typical candlestick chart. And I hear from a lot of traders that say, here's a very, very simple chart, but it still is confusing. You know, you've got red candles, hollow candles, black candles, you've got gaps, you've got the long wicks. Each one of the candles is telling you a story, and you can get so bogged down by trying to remember that what a morning star is, or a hammer candle, or what they all mean. Is 3 candles in a row, is that a black crow, or what does it mean? And it just can be mind-boggling and throw some traders off. So what we're going to do is we're going to simplify the chart so that the gap areas, the wick areas are not there to confuse the picture. And maybe this is the artist in me that is coming out, that I want it simplified, and I want the patterns and the potential to come out and tell me their story. So here's just a very simple line chart. And I'll just say as one rule that 3 touches of a line creates a trend line. So here we have 1, 2, 3 touches. That once you take out the fluff that you can see on a candlestick chart, all of a sudden this is creating more of a picture that you could remember when you were a kid and you did the connect dots. Well, that is kind of what you can do, and you can start doing it just with your eye. That maybe you would draw a line across what would be the top of these candles here, that you could draw another line at the bottom here of the candles, and you would have kind of a range that the candles or price went up and touched this point a number of times. It broke out and slipped right back down, tried breaking out again, and then dropped. Here you have a range at the bottom, and it only is now in this most recent drop that it broke below what would be the lower support area of that trading range. And we're going to get more into this, but I just want your eyes to start taking in the simplicity of a line chart. So this is the a different view with more days added. This is the area that we were looking at, and this was the diagonal line that I had drawn. So this is a trend line where it touched the trend line a number of times. And so for us, what our rule was, or our trading plan, would be to enter should price break through the diagonal line that we had drawn. And it did, and this is where we entered. Then once it starts going up and down, you can draw another diagonal line that will become the new trend line going up. And your exit point is going to be when it breaks down below the trend line that you have drawn and put in place. A stop would have been if price had gone down here and dropped back below this diagonal line after you had entered. And from that point heading up, you can do a trailing stop or whatever. That I find that risk management is kind of a subjective subject, that you can one person is maybe comfortable with a 10% loss. Another is, once they're in, 50% loss. Well, as far as a trailing stop, you can set it, you don't want to have it too close, but whether it drops 20%, you could decide to exit on that. So you are entered here and moving up, and once it crossed down below your diagonal line, this would be your exit. So the general principle here, and again, we're just talking in generalities, your trade requirements would be that you are going to trade weekly or front month options. You're going to follow strategy guidelines as far as your expiration is going to have the required open interest and volume. The bid-ask spread is not going to be too large. You're going to have know what the delta is, and you are going to only trade stocks that have large moves, and you are going to set up your chart in the way that I have here, and you're going to add a couple confirming indicators that tell you, yes, when you see a breakout, that you are going to have the momentum of the energy of the stock supporting the direction of your trade. And then you're going to set stops and profit targets. So here's another chart. And again, I intentionally did not draw a lot of lines on it because I would like for your eyes to start taking in the potential of connecting the dots, drawing lines. You could draw a line here across the top that would show that this is the high, and it quickly dropped from that. Here it tried to get up to that point again and didn't make it. So you could just draw a line here and say that a breakthrough of this line then could start, say it went up from here, would start a new upward trend. You could draw a line across the bottom here of the lows. You could draw a line here in the center. You have this little point here, and then you have two other touches in the same area. You just draw a line across there. You have this long trend up this way. So a number of lines could be put onto the chart. We're going to see what this looks like. Here we go. So you're looking at this and you're thinking, okay, if it touches this line and bounces up, you could consider getting into a call trade. If it breaks down below this horizontal line, you would consider a put trade. And so what you're doing by drawing the lines and having these different options, in a sense, what you're doing is you're waiting for the equity and the market to show you what's going to happen. And you are going to trade what is handed out each day. You're not guessing and saying, well, I think it's going to go up, it's going to go down. You have noticed by, again, drawing your lines, what you think different possibilities are, different scenarios, and then you trade what actually happens. And you're prepared for it because you've already kind of played out in your mind, well, if it hits here and bounces, I'm going to do this. If it breaks through here and drops down, I'm going to do that. That you have it all covered as far as your plans in place of what you're going to do. So here we have what took place in this particular trade was that we had drawn this horizontal line and price broke down below it, and we said, okay, I'm entering a put trade here. And we'll follow it through, and this is exactly what happened. It dropped and it dropped. It came up and it touched the line, continued down, and here you start noticing some volume candles, some buying coming in. The line is kind of turned up, and it's a weekend, and you just decide to get out at this point. That it's had a nice drop is perhaps putting on the brakes and slowing down. So let's see what happened. That on December 2nd, you purchased the October-December 2nd week expiration. On December 4th, Joy's stock was $42.25. The price move was $3.25, which was a 7% move. On entry, and I mentioned that we got the December 2nd expiration, and we didn't. We got the December 1st expiration. We entered on December 1st, and we got the January 16th 45 strike. I'm sorry, I'm like reading ahead and jumping ahead of myself. So the price was $45.50. Joy's price on the 4th was $42.25. It had dropped $3.25, which was a 7% move. So that's a good size move, way more than what I normally look for at a 3 to 4% move. So looking at the option, we had an entry on December 1st. We got into the January 2016 45 strike call, and it was $1.35 per share, or $135. And let's say that we purchased 5 contracts for $675. Again, that's in the $500 to $600 range, a little bit more than 6. Then on December 3rd, the bid was $2.95, which was $295 for each of the contracts, or $1,475 for the 5 contracts that we purchased. This is a $800 profit, or 119% gain. So again, here we found a stock that on average had nice moves, was able to get in, and we were in for 3 days and was more than able to double our money. And this is the same chart, and again, I had mentioned earlier how sometimes you can ride stocks up and down. And so we had exited the trade right here where it had crossed back over the diagonal line. We had a low at this point, and if you draw another horizontal line here, that you could conceivably consider getting into a call if it moved up through this line, or a touch of this line at this point can act as resistance, and it could drop down further, and you could then enter a new put again. Oops, I think it skipped 2. There we go. Let me see if there was I actually skipped 3 here. Okay, there we are. So what happens is it did go up, it touched that line, and it did retrace and go back down again. So this would have been a situation where you were prepared to trade either way. And again, what you did was to wait for the market to show you what was happening, and then you reacted because you had a plan in place to trade whatever decision it made. This then was a 5.3% drop, and again the premium would have more than doubled. Here's a Goldman Sachs chart, and we've again kind of connected the dots that we've lined out what the highs are here, kind of at a mid-level. You could have drawn some lines here at the top. The horizontal line here is the most recent trend line, and so you have several things that could happen. It could touch this line, break out through the horizontal line, and would be an opportunity to get into a call trade. It could come up here to this resistant line, drop, break through the trend line here, and it would be an occasion to get into a put. So we're not anticipating and jumping the gun and saying, well, here it touched, I'm gonna get into a call, or you are preparing a plan ahead of time and knowing that you have these different scenarios that could play out, but then you wait to see what happens. And by thinking this out ahead, by drawing your lines, you are able to then have a plan in place that you know what you're going to do, you know what options you're going to select, you have your other criteria in place, you have your confirming indicators, and when the next day's price activity comes about, you just go with what your plan is. So here, as mentioned, the two choices that it could do, it could have broken through and continued up. In this case, it bounced off of this resistance line. It then dropped through the support of the trend line, and you would have entered a put trade right here. This is where we entered, and after it has done its little zigs and zags here a little bit, we can begin drawing a new line. Now I drew a stop in here that had price gone through that area, you would have closed the trade because it would have stopped out. There was a highs here, highs there. Had it broken above that, that would have been your stop. You drew in your horizontal line down here, and eventually it broke through, and it did continue down, but this is where you exited following your guidelines for exiting, having crossed through the diagonal line was your stop. So here we had entered the trade on December 2nd when the stock price was $191.50. The price on the 9th was $184. That was a $7.50 drop, which was a 3.9% drop in price. On December 2nd, you purchased the January 16 strike for $5.70 or $570 per contract. And let's say you just bought one contract because we're staying again in that $600 range. The bid on the 9th was $11.80. This is $1,130 for the one contract. That's a profit of $560 or 98% gain. This trade we stayed in a longer period of time than the average. This was a period when the market was dropping and supporting the bearish direction of the trade. And so because of the overall momentum, the bearish momentum, you stuck with it for a couple extra days because that was the overall direction, not just of the stock, but of the market. So for wealth building with weeklies, you work with the leverage of weekly options. You stick with trades on equities that have large daily movements. You look for trend lines, support and resistance areas, and you use these to come up with a plan ahead of time, that you see what the potentials are, that if it breaks through here, you're going to do this. If it drops from there, you're going to do this, so that you have a plan in place ahead of time. You locate divergences that might give you a clue or a hint, and this is done by a couple other indicators on the chart. You use confirming momentum indicators that help you to see that the momentum is going into the direction of the trade that you've entered. You trade breakouts and breakdowns. You select the right option based on the strategy rules as far as open interest and volume and spread and delta and so on. You apply stops. When you get into a trade, you have a stop in place. You know where you're going to get out. And you set profit targets. And based on this, you know that a 2.5%, 3%, 4% move is going to work out to be a double plus option premium. So the wealth building with weekly options comes with a option book, a newsletter that gives you candidates every week. It comes out on Wednesdays, that shows candidates that are setting up for potential breakouts or breakdowns. And then there is advisories and that are auto-tradable. You can look up information on wendykirkland.net. And we have a special offer for attending this afternoon. That this is a clickable link, and Raleigh has posted it in the chat room there for you to look at and get more information on it.